Our next panel will focus on the rise of non-bank finance, implications for insurance, pensions, and supervisors, and will once again be moderated by Catherine. So Catherine, I think once again, and once again, you will come to the stage.
Perfect. Okay, well, thank you very much, everybody. Welcome to this session on the rise of non-bank finance, implications for insurers, pensions, and supervisors. So in recent years, non-bank financial institutions, or NBFIs, have become more prominent in financial intermediation, attracting greater attention from authorities. Under the MBFI label, we find insurers, pension funds, asset managers, investment funds, private credit funds, and others. Very different business models, very different balance sheets, different regulation. The risk profiles, the market dynamics, they also vary across countries and sectors. And at the same time, their connections to the banking system have deepened, creating new channels for contagion and amplification during stress. There's increasing regulatory attention that's being paid to the sector. In the EU, the Commission has announced it's considering targeted actions next year to strengthen macroprudential oversight and enhance the EU financial system's resilience. We obviously heard from Klasnot this morning that it was a priority for the FSB, and that continues. So today we're going to dig into the state of play around NBFIs, where the risks and opportunities are, and the supervisory responses that we can be thinking about. So let me introduce our panel. We have Dimitris Zaferis, Head of the Risks and Financial Stability Department at EIOPA, Francesco Mazzaferro, Head of the Secretariat at the European Systemic Risk Board, François Gilles, Group Chief Risk Officer and member of the Management Committee at AXA, and Professor Loriana Pellitzon from the Leibniz Institute for Financial Research, SAFE, Goethe Institute Frankfurt, and Ca' Foscari University of Venice. Thank you all so much for being with us. But first, we have another Slido question. I know this is your favorite by this point. I think you should see the QR code, yes. The question is, what is the biggest emerging risk from the rise of NBFIs in Europe? The responses are geopolitical shocks, interconnectedness amplifying contagion, data gaps and lack of transparency in MBFI activities, regulatory arbitrage, or valuation risk. I'll give you a moment to come back on this one. Okay, interconnectedness is in the early lead. I'm glad to see we're getting some more participation this time around. There's going to be more Slidos, so keep your phones at the ready. Okay, I think from this, interconnectedness is the clear winner. Data gaps are second, followed by geopolitical shocks. So thanks so much for responding on that one. Okay, let's dive in. Where are we now? So let's think about NBFIs, the risks, the channels that they transmit through. Dimitris, I'm going to come to you first. So obviously over the last decade, we've seen a massive rise in the NBFI in Europe, in the US. There's lots of different entities that are considered in this same sort of category. Seeing as there's very different entities that are sort of put into the same bucket, whether it's, whoever's looking at them, maybe you could talk us through the main categories of MBFIs, talk about how the roles, the risks, the regulatory needs differ from each other.
Thanks, Adine. Thanks for the question, because it touches upon something that's quite close to our heart and in discussions we are having with our colleagues. Indeed, in the last few years, in the last decade, actually, there has been a quite significant increase in both in absolute and in relative terms in the weight that non-bank finance has in the economy. This has been driven mainly by equity funds, by all types of funds, including also hedge funds. But of course, these were not the only non-bank entities that they participated in this increase. What now is relevant here to distinguish is the fact that this has been an outcome of what we call a structural shift. It was the outcome of what happened post the financial crisis, the need for deleveraging in the banking sector, but also an increase in the demand for market-based finance in the economy. And we are where we are now, that the relevance of credit in the economy coming from sources outside the banking sector is here. Nonetheless, what is also here is the sometimes oversimplifying discussion of non-bank entities. So we include in one bucket things that they are very different. And perhaps this oversimplifying discussion leads to, let's say, unintended consequences. Let me start by the term itself, which creates problem. We are defining something by something that it's not. So there are many things that they are not banks in the economy. Making an analogy also, you can define a cat by describing it as a non-dog. It doesn't help much describing what it is. So going back to what we are trying to define here, there are many different characteristics and many different economic functions that they are performed by non-banks. You have insurers that they do risk pooling, they try to safeguard policyholders in their future needs, protecting by adverse events. It's very different than what perhaps a money market fund, which in principle is a cash management vehicle, is doing, a pension fund that caters for our future income, also of our future ED, wives and kids, what I heard in the first panel. So they are very different perhaps from a private credit fund that invests in, or a private equity fund which invests with the purpose of long-term capital gains, a hedge fund a bit more short-term opportunistic. So they are very different economic functions. When you have very different economic functions, usually you also have very different risks, especially when they come from your liability side, when they stem from your obligations towards your clients. So definitely, we even see it within sectors. Even if you look at the pension sector and the difference that it may, the shift from defined benefit from defined contribution may entail. So you can imagine how much different it is if you are talking about what kind of portfolio I have in a money market fund versus an insurer. So completely different. So is it irrational to assume that the different regulatory approaches are applied there? I guess not. And this is the case. Taking a closer look at the insurance sector, so when one looks at the insurance, you have capital requirements, you have a quite demanding reporting framework. Does it help when you read a report that says more information is needed in the non-banking sector? You can read it both ways. You can say, no, in the insurance sector we have plenty of data, so no data is needed in the MBFI, which is wrong. Also, the opposite is wrong. You can read a report that says liquidity risk is on the rise on the non-bank, on the MBFI sector, and it's interesting that they call it MBFI sector sometimes. Where is it? Is it in a hedge fund? Is it leverage risk? Is it in a money market fund on the liquidity? Is it on an insurer? Is it in everyone? Sometimes I'm not so sure if this discussion and this labeling MBFI helps or actually creates obstacles in managing risks. So what I would say, maybe concluding on this one, I think what's important is to acknowledge the sectorial differences and keep this in mind when discussing ways of dealing with these risks in order to avoid, let's say, miscalibrated policy options or policy discussions.
Okay, thank you. Francesco, so thinking about this structural shift with the growing interconnectedness between MBFIs and different sectors and banks, what do you think are the financial stability implications that come out of that new sort of framework? And what are the emerging risks that you see for systemic stability?
Thank you very much. No, first of all, thank you very much for inviting the SRB. Congratulations to EIOPA for 15 years. It's also 15 years of the SRB because we have been created together. And of course, the caveat is that I'm speaking here in a personal capacity. So it's quite interesting that in the slide, interconnectedness was seen as one of the core problems. Now, perhaps I've been doing this job for some time, and one of the things I have been, so if you have been speaking 15 years ago, I would say it's a massive problem, everything can go bust. Now, today, perhaps I'm taking the view that we should not immediately cry wolves. Because it is natural that different business models meet contractually. There is no contract possible if everybody is doing the same thing and is having the same needs. So the question is the nature of the contract. Not only the difference in the market is also a line of defense against a systemic risk. Because if something goes wrong, at least you have the hope that somebody is, so to speak, in a position of gaining, and, for example, and is not also forced to fire sale. So, for instance, okay, now we are speaking of new players. Now and I don't say this in the sense that we don't have to work. I say in the sense that we have to understand where the issues are. Private markets are, for instance, provided that they are operating in a strong way, have the advantage of being less cyclical and less pro-cyclical, because they don't depend upon very much on pricing. Of course, the other side of the coin is the fact that there is a lack of immediate transparency of the transactions. But if you are in the silver market, which is going up 150%, if you are completely pro-cyclical, you're dead. Okay, so it's simply like this, okay? Because the margin calls are killing you. The liquidity squeeze is killing you. So the private lenders are also less subject to run risk than banks, because they don't have a massive depositors which would go at the branch at 5 a.m. to take all the money there. And for instance, the sovereign wealth funds might have a longer perspective than a normal financial operator if they're doing their job as a sovereign wealth fund, because they are there to protect their country, which is there forever, and to a certain extent has this perspective. On the other hand, it's obvious that there are players which are in the market with a bias to short-termism. So we need to know who is who, and we need to know what is the nature of the contracts. And we have, because we were speaking about liquidity, a number of players which do not have access to central bank facilities. So at the very end, if there is the need for the central bank to intervene, there are some which can be reached and some which are out of reach. So it's very important to make a difference between who is there to amplify the risk and who is there to absorb the risk, and very much to understand the business models. Now, to make, for example, one example, okay? So these days, we are in a situation of incredible uncertainty. Nobody is able to tell you what is happening next week, okay? So now, of course, and high volatility, very high volatility in some markets. Now, in this situation, you need counterparts which have very strong nerves, okay? Because if the people are panicking, then there is an issue, and we need a long-term attitude to risk. And so one of the things which we will have to discover is what is the attitude to risk, and what are the nerves of these new players. So we know what banks, what insurance are able to do. We have been experiencing a long crisis which started in 2007, 2008. We had the sovereign crisis in 2010 to 12. Today, our players are stronger. So they had strong nerves. They were able to stay there, to absorb the risk, to solve the problems. Now, we will have to understand what is happening with the new players.
Okay, great. Thank you so much. Françoise, turning to you. So we often see that insurers are sort of put into the same category with other MBFIs in the public debate, but they manage long-term liabilities, they invest with long horizons, they provide stability to businesses. From your perspective, what do you see as the challenges that come from insurers' larger engagement in activities like private credit and investments in other alternative assets? Do you think that the reshaping of the risk profile can reduce the stabilizing role of insurers on the markets?
Thanks a lot, Catherine, and hi everyone, great to be with you. I would love to build actually upon the great points that both Dimitris and Francesco made. I love the analogy of the non-dog, for qualifying a cat. And I think that's a key element. When we talk about both NBFI as a basket or private assets as a basket, there are many different animals in both of these baskets. So it's good to open the basket and look at each animal in there. And indeed, to your point, Francesco, exactly when you look at those different animals, what is their attitude to risk? Are they shock absorbers or are they rather shock amplifiers? So then, if we open the basket and we look specifically at insurers as animal when it comes to a non-bank financial institution and investing in private assets. Maybe we take 1 second to zoom out, Catherine. We zoom out and collectively, if we look at the challenges that we face, we have a triple challenge today. If we look at demographic trends, it's a fact. We have an aging population. Birth rates are falling, and this creates a pension topic. That's on the one hand. On the other hand, and it was a very acute discussion last week as well, there is a need to invest. We want in Europe to invest in defense, in infrastructure, in the broader economy. This is the second fact. A third fact, public finances are getting tighter and tighter. So adding yet more pressure on the pension topic and on the need to invest. As insurance industry, and together with academics and with supervisors, we want to be part of the solution. So what can we do there? Addressing the pension topic, addressing longevity risk, long-term commitments. This is what insurers do. What we can do is manage that longevity risk and channel long-term savings into the real economy. This is easier said than done. The good thing when we do that, as being the insurer animal in that basket, we are a highly regulated industry. Nothing is perfect, but we have some level of maturity when it comes to managing risks, when it comes to having capital frameworks, we have liquidity frameworks, we have risk appetite frameworks, we have the governance, we have the reporting. We have all that in place. So further building upon that gives the opportunity to then indeed contribute to being part of the solution to the collective triple challenge that we face as a society.
Okay, thank you so much. Loriana, turning to you now. So you've obviously done a lot of research on systemic risk and interconnectedness. When you're looking at the data about MBFIs emerging, the interconnectedness with banks, what does the evidence show about how shocks propagate through the current financial architecture? I mean, this growing position of MBFIs, is it changing the way that risks can propagate? And what lessons should we draw from past crises around this?
So first of all, thank you very much for inviting me. And I want also to clearly subscribe what it has been already stressed, that they are not all the same animals and so on. But I think an important aspect that we need to start to investigate is, are we having all the animals in the basket? And how big is this basket? So if you take a macro perspective, and I'm asking to all of you that I think are quite expert, how large is the financial sector in Europe over GDP in Europe, where you're putting together banks, MBFI, and so on? Some can tell some number, and how much this compare with the US? Well, I provide this number in the recent Sintra ECB forum, and based on official data, you can see indeed that in Europe, we have an increase of all the financial sector over GDP, and we reach pretty much 7 times the GDP now. It was pretty much 4 in 2020, or 3.5 when we started in 2000. If you compare this with the US, US started before to grow, but after the great financial crisis, pretty much all the total financial system remain around 5 times the GDP. So this means that in Europe, that we are highly bank, let's say, concentrated, the financial system altogether is larger than the one in the US, if you not in nominal terms, but with respect to GDP. And clearly, it's true that we are bank-centered. In fact, the banking sector accounts for 2 times the GDP. In the US is 1 time the GDP. But what we call, whatever it is, non-bank financial intermediaries, it counts for 3.8 times the GDP compared to 3.1 in the US. So we are all saying that in the US is more market-based and so on, but in Europe, from the statistics provided by the ECB, what we are calling non-bank financial intermediaries, that is insurance, pension funds, asset manager, and then a significant fraction that is called other financial institutions, is growing and is larger than the US. So this is statistics. So I'm not going to tell you it is a risky, is a problem, is not. But I think that all of us need to start to ask, why is it the case? Is it good for the society to have this very large financial sector compared to the US? And is it really going to help Europe to be, let's say, more wealthy, more equal in terms of distribution or not? On the other side, is making us more risky also. On the other side, another important question we need to ask to all of us is, why is the case? Is it because maybe we have a longer intermediation chain? And if this is the case, what are the risks that all this intermediation chain is creating? So all these aspects has to be deeply investigated. And the second point that I want to stress is that if you're looking across Europe and you are looking to where these non-bank financial intermediaries are largely concentrated, I'm sure that easily you can guess there are some countries that maybe are very tiny where this huge amount of institution, at least legally, in that country. And we can easily say is Luxembourg. The second one is Ireland, and the third one is Netherlands. The composition matters, I agree. And I think that what we need to care the most is what there is in the large basket that is called other financial intermediaries. Because really, it is very difficult to figure out. So in this basket, that it is pretty much almost 2 times the GDP in Europe. There are no pensions, there are no insurance, there are no investment funds. There is something that is very difficult to figure out. Maybe it's just vehicles that are not relevant, but we have no idea. At least there are no official data about this type of institution. And I think that this is where maybe we need to try to understand if they are cats, dogs, what are they and what are they doing? Just to clearly, I can go on because I wrote, and I'm suggesting to all of you, if you have time to read what I wrote, is a long document with a lot of statistics where I'm also talking about financial stability and so on. But if we go and try to summarize what is then the suggestion that we have regarding risk and for supervisor, I think that these data already are telling us that we have opacity, even if we know some number, but we don't know what there is behind. And this opacity is coming on one side, not because we don't have the data, because these data are in the different national competent authorities, and we are not able to look the full picture. So I think that if we want really to move and try to understand better where the risk is, we don't need maybe to ask more data. We just need to try to put all this data together. And it shouldn't be so difficult from the technical point of view, It is for sure not difficult. We are now living in a world of big data, but clearly we have some friction, let's call friction, that is called political friction. And I think that it's time, really, that if Europe would like to become an important and really a unified, let's say, financial system, all these data are reported in the same concentrated repository in a way that this data can be easily, put together. And this will give us a better picture, because we can do a lot of legislation, we can discuss, we can write a lot of reports, but if we don't have this type of information that, as I said, they are already available, but they are distributed across all the different countries. EIOPA did a good job so far, and you see how good it is, this result. So why we are not having, after 15 years, a database that is putting together all these data? So this is, I think, the first thing. The second thing is not enough to have the data, but you need to have the power. The power to have a proper supervision, that therefore, again, it has to be concentrated and unified. Otherwise, we can talk. We can talk about risk, the capacity that we have to collect, investigate, or maybe have an integrated financial markets. But if we have all these type of frictions, we are not a single, let's say, saving and investment union. We are just a lot of different markets, tiny markets, with not too much liquidity. So I think with all the input that we have in the last, let's say, year, it's really time to move on. And if we want to know how much risk we have, we can do a systemic stress test as soon as you have the data. And we have the data, but all spread around. Thank you very much.
Thank you. Maybe not a systemic stress test, but it is time for another Slido. The new question is, what should be the top EU priorities for making MBFI safer over the next 5 years? And the options are understanding differences under the MBFI umbrella, closing data gaps and improving transparency on MBFI activities and interconnectedness, strengthening cross-border and cross-sector coordination, removing obstacles to market-based finance while keeping risks in check, or not sure. Okay, looks like data gaps is way out in the lead there. Anybody have thoughts on this one on the panel? Are we all data gaps? Okay. Looks like data gaps is the clear winner, followed by understanding differences under the MBFI umbrella. Oh, no, cross-border coordination is a late second place. But I think we're coalescing around broadly the same data gaps. Okay, let's move on. Where do we want to go from here? Let's talk about policy, supervision, the opportunities that we have here. Dimitris, insurers are already under this very robust microprudential regime. They've got Solvency II. There's macroprudential elements in there. From the perspective of EIOPA, how much do you think sectoral specifics like capital requirements should be a central consideration when you're creating a macroprudential framework for MBFIs so that it's actually adding value rather than duplicating or conflicting with what's already there?
So, in principle, any kind of macroprudential approaches should be consistent or complement what's already there in the micro level. Of course, when you start this type of discussions, you enter into definitions. What is macro? What is micro? Do they meet? Where do they meet? Let's keep this out of the discussion because it could take hours, and I'm not so sure it's beneficial nonetheless. What perhaps it's meaningful to say is that firm-specific stability does not necessarily mean sector-wide stability. Sector-wide stability does not necessarily mean system-wide stability. So there needs to be some kind of, let's say, going up approach and looking things top-down. The need for consistency, however, is there. And I will use insurance as a real-life example because that's something we've done, and we've done also together with more macroprudential colleagues. So 7-8 years ago, if I dare to remember, we started some work on recovery resolution for insurance or a potential macroprudential framework for insurance. Now, back then, our concern was not to replicate or not to copy and paste what has been going on in the banking sector. We were trying to cater for the fact that insurance is different. Different doesn't mean that there is no need for any macro discussions, but different. And indeed, back then, we had our own analysis as a microprudential institution, EIOPA, starting from a more or less bottom-up approach. Our colleagues from the SRB were working also on this area, assuming with a more top-down approach. We concluded more or less on the same necessary tools, which were not replicating what happens in other sectors. So on resolution, as the insurance sector did not have this over the weekend type of necessity, we still have other tools in place and a totally different approach than what our colleagues in the banking sector have. When talking about macroprudential tools, no, it was acknowledged that this counter-cyclical capital buffer is not something that you can necessarily apply to the insurance sector. Why? There were other tools already in place. You can discuss calibrations. There was the so-called LTG measure. So there is the volatility adjustment. We had the symmetric adjustment to the equity capital charge. You can discuss how symmetric these are, if you can go with one direction or the other, but there is something there. And including or copying and pasting what's from the other sector, just patchwork that makes no sense. And I think this was well understood. It was fed into the Solvency II review, and we are somewhere now that combines and I think takes into consideration the specificities of the sector. Now, going back to the whole non-bank discussion, there are different frameworks in place. We said the insurance sector has capital requirements, has reporting. Other sectors, it could be money market, it could be hedge funds. They don't have so much of a balance sheet approach. They have a bit of an asset management approach, some conduct type of regulations. It's a bit more qualitative. So definitely you cannot apply the same type of approaches when having a macroprudential discussion. Nonetheless, I'm going back to animals. If it walks like a duck and it quacks like a duck, so maybe it is a duck. And I'm going to use as an example here, private credit. So if there is a good number of institutions that they provide a good portion of funding or credit funding in the economy, then there may be a discussion that needs to take place because these institutions may also influence the credit cycle. They may also influence monetary policy. Maybe some of you have seen a paper published by the BIS in December last year. So there could be discussions that they need to take place. Discussions, of course, don't necessarily mean capital charges, anything related than that. But discussions, how do we cater for the fact that now we enter perhaps a different world, that there are other factors that they can affect the system and the stability of the system. Now, I mentioned before that it is wrong to put everyone in one basket, having these umbrella terms, even more having policy actions in these umbrella terms. It's equally wrong to go to the other side completely, work in silos and have each sector trying to deal with this type of issues on their own. There is this need for coordination, cooperation. There are platforms. We have the SRB, also other platforms that we are all there. Microprudential, macroprudential, NCAs, European institutions, that there are many things that they can be done. Interconnectedness definitely is one of the issues that needs to be tackled, needs to be assessed properly. Data and data sharing is something that is necessary to go into that direction. Stress testing can be sector-wide stress testing with increased transparency. It could be system-wide stress testing. That's something that would include all sectors. So definitely a lot of things that can be done and not necessarily going into very intrusive tools.
Mm-hmm. Okay, Francesco, so we've talked a lot about how those links between MBFI and banks are increasing. What do you think needs to change the most in how we look at those risks, how we analyze them, how we regulate them, to make sure that those interconnections are strengthening financial resilience rather than bringing new risks?
Let me first of all make a comment. We have been speaking so much about animals that perhaps the next meeting we could do it at the Frankfurt Zoo, which is not very far from me. It's a very nice place to be. They have also very nice premises, and we could discover there are not only cats and dogs, by the way, and batsmen. No, I think what we are, let's try to see what we are trying to do, being humble about it, but also having tried to have a sense of direction. So our ambition is to be ready in 3 years to have a system of top-down stress testing, which is looking at the propagation of risk within the entire financial system. And then, of course, one has to think about the caveats, because there is the question of complexity, the question of data, the question of doing it at a cross-country level, the cross-sectoral level. And let me give two examples of questions where it would be useful to know how the different sectors are interacting, okay? So we have in these days, contemporaneously, the situation in which in Europe we have the shifting of the Dutch pension system, which is a very large one, and we are speaking about something, speaking of multiples of GDP. So the pension system in the Netherlands is by itself much larger than 1 times the GDP of the country. And they are doing it for reasons which are extremely well understood in a very orderly way. By the way, Dutch pension funds have a very good way of mastering risk and this type of things. We have also at the same time the broadening of index policies everywhere. I was speaking recently with some colleagues from Japan, and they were explaining what they're doing there. These things are very good in sense of mitigating the dependency of financial corporation from interest rate duration. But of course, it has an impact on markets. And it has an impact on markets because also reduces the systematic demand for long-term assets, because you need much less to have long-term assets to match the long-term liabilities. And then, of course, this is one of the reasons why we have been seeing there are other reasons, because there are political reasons, if you want, financial reasons, fiscal policy reasons, why, for example, the yield curve in Japan has been moving so much, which has been, of course, also affecting the yield curve in Germany, possibly also in the States. And so one of the things which one would need is to try to see these things together, because there can be a shift of risk. Risks are very rarely simply abolished. No, you don't abolish risk. And the financial system, by the way, is based on risk. And you shift it, and then of course you have to understand you shift it to whom and how. So this is, and so to have a tool which is able to understand what is happening in terms of shift risk is important. The other ones, which is important, I think is more linked to MBFI, is the fact that we are now going into a system. So if we were discussing a lot of long-term LGT measures and this type of things, because of course there is the question of matching liabilities and assets and try to understand what is the implication of capital and so on. Now with private markets becoming important for the insurance sector, what is happening is that they have different solutions. Things which we didn't expect only a few years ago. And so then you have a situation in which you can basically match the liquidity premium on one side with the liquid nature of the liabilities. And so if you do it well, it functions, it's useful, and you make also a lot of money. And we don't have anything against. But of course, the real issue where one has to stress test is what happens when there is a huge market dislocation. Okay, so is this resisting a shock? So we are speaking really a big shock. And so these are the things on which I think we should have an ambition to have a tool to discuss risk propagation. Thank you.
Okay, thank you. Francoise, let's pivot here a little bit and think about the business side of things. Where do you see business opportunities in a more structured MBFI framework? I'm thinking about areas here like long-term infrastructure, transition finance, private markets. And is there anything on the regulatory side that would help the industry lean into this role?
Thanks, Catherine. A couple of points here, and I'd love to touch upon indeed Loreda's point around transparency, also interconnectedness, and also stress testing. Both Francesco and Dimitris, we regularly talk about stress testing and the interest of it. I think so. I touched upon the, you can call it a business opportunity or you can call it a societal need when it comes to addressing long-term savings and the need for investments. This is one thing. When it comes to the regulatory environment in which we operate, one is we are happy with a risk-based Solvency II framework. The fact that it is risk-based is essential in here. And also the recent revision goes also in that direction. I think it's also good that as we invest long-term in this type of investments, because those are long-term commitments, it's good that we continue, as we have today, to have stability and predictability on potential changes in the regulatory environment, such that we can anticipate. This is one. I think when it comes indeed to the importance of transparency and understanding which type of private assets we are looking at, also in the context of, all the regulatory tools that we have, but also the risk management tools that we have when it comes to not only capital requirements, but how we stress liquidity and how we report that. It's good to go a little bit deeper than just the category of private assets. It is quite granular, and you have quite a number of very different animals in there. Sometimes you put in that basket, you have animals going from private placements to residential mortgages to infrastructure. So it's good each time to first identify what are we talking about, and then opening that box and identifying the risks related to that instrument, and then adapt, both our liquidity stress tests or risk appetite or capital requirements on the specificities of that asset. So I think having that good granularity and also the good dialogue and the good relationship between, the regulatory tools, including the stress testing, that they are appropriate to, the different private assets. And a very important one, which you touched upon, Lorena, around the interconnectedness. I think this is key in this category. And making sure that we have along the chain, and we would like the chain to be as short as possible. And when there is a chain, we need to make sure that we have an alignment of interest. We need to make sure that from originators to banks to asset managers to insurers, we have skin in the game along the value chain. And I think this is key. So there's a couple of elements that we want to put in place such that the whole system is safer.
Thank you. Loriana, I have sort of a similar question for you. So we've talked about the role that MBFIs can play in channeling capital. How do you see this in terms of how we unlock the potential, but in a way that's still safe in financial stability terms?
So I think that there is one aspect that the non-bank financial intermediaries can play in terms of improving the investment in Europe, and it is the fact that they don't have the cross-border limitation that so far we have mostly for the banking sector. So just to make a simple example, if you have an Italian bank that is having deposits, and with this money they want to lend in another countries where this is not possible, or at least the supervisor of that country will have something to say, because there is all this issue about the deposit insurance, and so far we didn't have a perfect or at least a complete banking union. But on the other side, if I want to invest in a mutual fund that is located in another country, well, this I can be easily done. and or to invest in stocks that are not Italian stocks or German stocks or whatever. So I think that there are pros and cons, and so we need also to emphasize that some of the friction that we still have in the financial sector in Europe that are strictly related, for example, to banks, and in part also to insurances, well, some other type of institution like investment funds do not have. So they can really help, and maybe also private credit, but then we need to distinguish what type of credit, what type of contract, what type of legislation they will be associated and so on. But if we want really to have growth in Europe, we need to help the money to go where it is more profitable, and in a sense, it will help more growth. So all the cross-countries barrier that we have should, in a sense, be tried to reduce. But on the other side, since the non-bank financial intermediaries have a different business model, are under-regulated, because this is a fact, well, at the end, at least the positive aspect is that you have a lower number of cross-border limitation.
Let's open the floor up to some questions now. Do I see any questions for the panel? Any hands in the room? We should have some mics. I'm going to give you a minute in case anybody is feeling shy. Still no questions? Yeah, you all came here in person. Okay. I'll take over again. I'm going to have the same question to all of you for our final round. What's the one thing that you'd like the audience to take away about MBFIs, whether it's on the opportunities, whether it's on the risk? What should we be getting right in the next few years? Whichever order you want to come. You want to come in first? Yeah, absolutely.
In fact, if I may, I have a bit a plea to all of you, which is the fact of trying to understand what has been the deep meaning of Mark Carney's speech at Davos.
Yes.
And by the way, Gabriel will remember, we had in the ESRB table on my left, Draghi, on the right, Carney, so which gives the idea of how much the people who have been working in our community have been then at the center of policy design. So what Carney has been saying is no nostalgia of the past. You have to prepare strategies for a tough future, okay? And I think it's very clear, this is a tough, brutal, and power-based world, okay? And the consequence of this is that the demand for insurance will increase. Because insurance is not a luxury. Insurance is the tool for survival. If you don't have insurance, you don't survive in the market. Now, there is already a sign that this is happening, and for me, the most interesting one is what is happening in the forex markets. Because since 1-2 months, people are systematically hedging dollar positions. And economically, hedging is insurance. Okay, so there is a huge demand, total demand. Entire Asia is asking for insurance against the dollar. So insurers have to understand that there is potentially a world for them. Okay, so now there are new needs, which of course means also new strategies and new products, because you don't solve this with life insurance. So you have to think about other things. Now, if Europe is circled by enemies, okay, and governments do not have pockets to defend everybody, there is a residual which has to be covered by insurance. Insurance or not. But think about things which are incredibly strange. I mean, these things, if I've been thinking about this a couple of years ago, I thought I had a nightmare. But can I insure myself against tariffs, against sanctions, against the weaponization of financial contracts? But these are... And the other thing is, now we are diversifying trade, which is good. It's good that we have Mercosur. It's good that we have India. But of course, it's different to have 30 years relations with the US and to work with new partners. And maybe this also implies new insurance needs. And so what I wanted to tell the people is, please don't continue to focus like we have done on 10 years on tweaking the regulations. It's not the public sector which will make a difference on your future. It's you. If you're good, you will make a lot of money. Otherwise, not.
Okay, who wants to come in next on that? Very nice note.
Let's be good. Let's be good collectively. No, thanks a lot, Francesco. So I would like to echo your words. Yes, the future is tough. There's quite deep challenges there, and definitely as insurance industry, we want to be part of the solution. And so let's look at the risks as a risk manager in the insurance industry. Let's make sure that we are present where we can contribute to the solution for society, and we are present in a sustainable manner, which means understanding how much risk we are able to bear, identifying, quantifying, monitoring, reporting, because there will be market corrections, there will be. The whole question is, are we able to navigate through those market corrections? And with the capital frameworks that we have, with the liquidity frameworks that we have, the risk appetite frameworks that we have some solid elements to be confident that, yes, we can take the tough future on and contribute to the solution.
Okay, who else wants to come in?
I can. So I'm in line with this, let's say, view that, it is a challenge, but it's also an opportunity. And I think that what we need to have in mind also in terms of regulation is that we were investing a lot of capital on all this international cooperation and the fact that we can have a level playing field about having similar regulation all around the world, and we will address in general issue together. Well, this story actually, what Mark Carey said, it was not really it was something that a sort of propaganda, but in reality now we know the truth, and we know that pretty much there are some countries that would like this and some other not. So what for Europe, I think is important to learn is that maybe we shouldn't wait or expect that there will be a lot of international cooperation, but we need to improve the cooperation that we have already, of course, in Europe, and eventually with other weak countries, as Mark Carey said, that are like us, but they have the same values as us. So what does it mean, to be more concrete, is that, again, we need to be indeed a system that is able to cooperate, and instead is not, thinking as 27 or 20, as 27 different ways to do the same thing, but try to have a system that is doing or looking to the same thing in the same way, in a unique way. And this means, again, I'm repeating, but more European cooperation, and on the other side, again, more willingness to share, to give up the national power, because this is what we are talking about, and, share and centralize more the information and the supervision.
Thank you. Dimitris, you have the last word.
Yeah, right. I decided to speak at the end because I was at the beginning before, but now I regret it because it's difficult not to repeat what has been said. Let me try. So, paraphrasing again, perhaps, diversity matters, meaning the non-bank sector is quite diverse and it is interconnected. So what one would need is different expertise to sit around the table, but also that there is a table. So going back to the cooperation, coordination, definitely on the supervisory or regulatory side. And making again an analogy then, no animals included, still borrowing from a phrase from the past, beware of the known unknowns when it comes to risks. And what do I mean by the known unknowns? We know, for example, that there is liquidity risk piling up in the system. Now, is it piling up by investing in non-liquid assets, trying to get the liquidity premium? Is it piling up through leverage in different parts of the banking or non-banking financial sector. Credit risk is piling up, again, in different parts of the financial system sometimes, and credit risk and liquidity risk are piling up at the same time. It may not be in your own portfolio if you're a market participant, or it may not be in the portfolio of the entities you're supervising if you are a supervisor, but it could be in the portfolio of an entity or a security that someone is investing in. So going back to the issue of interconnectedness and linking it to the notion of known unknowns, let's be a bit more careful of how much this interconnectedness will influence us with the smallest negative event. And by talking about negative event, I will conclude on the risks when it comes looking forward in the current environment. The only thing I would like to conclude, it was not mentioned, so I'm happy that I have the chance at least now at the end. Perhaps not to rely too much in this environment in quantitative models. Why? Or at least not only on quantitative models. Why? If you look to all the market parameters that most likely enter these quantitative models, what is it now? The interest rates, close to the target, inflation, close to the target, equity markets, most of them at almost all-time highs or super high, volatility, market volatility as measured by market volatility metrics, quite low. So one could see that and say, everything is green, no risks ahead if you rely only on quantitative metrics. But this is not the case. We have things happening, you touched upon them, that go beyond just purely quantitative metrics. All this geoeconomic, geopolitical discussion, the way the world is changing, you cannot really quantify it. So perhaps a bit of a more expert judgment approach is what we need now.
Thank you so much. I mean, it's hard to sum up, but let's just say the sorts of broad strokes are that obviously MBFI is going absolutely nowhere fast. This is something that we're going to be grappling with for a long time to come. And whether you're an insurer, a pension fund, a supervisor, everybody's doing their best to stay agile, to grapple with both the challenges, but also the opportunities that this sector can bring. So all that is left to say is thank you very much to everybody for your insights. Let's have a hand for the panelists. Thank you. Okay.